Welcome to lesson number 41. As usual, we do our homework question first, but before we do, I just want to give a little sneak preview about what you can expect in this class. In this class, we'll be talking about, we talked a bit about the monetary policy, where we have used expansionary monetary policy, and we're going to continue that, and the opposite spectrum is the contractionary monetary policy. After that, we're going to talk about just a review about what to do in a recession, what to do in an inflationary period, recessionary period, using a monetary policy to combat those two. Second is that we're going to talk about the open market operations, right? Open market operations is when the government sells and buys bonds to fix the economy using monetary policy again. And then we're going to talk about in detail how that's going to work. And then we're going to go over a couple different things like federal funds rate, discount rate, and if we have time, required reserve ratio. Speaking of required reserve ratio, let's talk about our homework question. Homework question is pretty simple, straightforward. We asked you what the money multiplier was. That being said, let's look over here. Money multiplier is equal, as in M, is equal to 1 over the reserve ratio. The reserve ratio, again, is set by the Federal Reserve Board, right? It is the amount that dictates how much money banks should hold within their reserves and how much money they can loan out. The required reserve ratio, if it says 10%, 10% of all deposits owned by a bank should be with them at all times. The rest of it can be loaned out, and they normally loan out the rest of it. So in order to find out what's the maximum amount that can be multiplied, what we do is we take this money multiplier, which is 1 over R, right? And then we multiply it by the excess reserves that a bank has. So if a bank has $90 in excess reserves, we multiply it by, let's say, if it's 10%, the reserve ratio, 1 over 10% is 10. We multiply it by 10, and $900 is the amount that the economy is going to have if it's multiplied to the max. Okay? Pretty straightforward, pretty simple, whatnot. All right, to my right is monetary policy that we talked about in the last class. We talked about expansionary monetary policy. Before I jump into contractionary policy, let me try to explain this real quick once again. So why do we need expansionary monetary policy? Even when we have an expansionary fiscal policy, why do we try to use this? Well, if we are in a recession, we need to expand the economy. Okay? If we're in a recession, we need to expand the economy. I hope that makes sense. So what does it mean when we have to expand the economy? We mean that we want to push the RGDP out. We want to push the RGDP out, meaning we want to push the RGDP up, okay? We want to make sure that the output is increased in the economy so that people have jobs, profits are up, and income is up, and they're good times, okay? So that being said, we can use an expansionary fiscal policy or an expansionary monetary policy. Well, in this case, we're talking about an expansionary monetary policy, okay? So the way we do that is we increase the money supply. How exactly we do that, I will tell you soon. Then we move on to the interest rate, right? Why is that? Well, when you increase the money supply in the money market, which is right below here, we see that the money supply shifts to the right. Okay, when it does, right, when we have more money in the economy, money becomes cheaper, okay? And this equilibrium between the money supply and the money demand gets to tell you the price of money, which happens to be the nominal interest rate, okay? So when we shift the money supply to the right, nominal interest rates actually come down, okay? And when they do come down, well, what we can get to do is we say, hey, you know what? Money supply goes up, interest rates come down. Interest rates come down, we actually get to link investment to that. Why is that, you ask? Well, think about it. You are a firm, okay, you are McDonald's, and you have a new idea, okay? You want to think, you know what? We've had the Big Mac for a while. We want to have, is it profitable to have a hot dog in McDonald's, okay? And your research team comes up with the idea and they say, yeah, actually it's pretty profitable to have a hot dog in McDonald's, okay? So what McDonald's does is it says the cost of enrolling a hot dog into McDonald's is about $100 million, okay? $100 million, that's the cost to enroll hot dog on the list at every single McDonald's in the world, okay? So McDonald's obviously doesn't want to use all their money. What they do instead is go to the bank and they say, hey, you know what? We need $100 million. The bank says, fantastic, right? You need $100 million. Here's the catch. You have to pay me interest, right? And so McDonald's says, how much? The bank says 50%. 50% interest rate. McDonald's goes, are you crazy? We're going to go back. We're going to use our own money. Well, they probably will scratch the idea, right? Because don't want to use their own money. So 50% interest rate, right? Quite high because it's a huge loss for the company. But now let's say that McDonald's goes to the bank and they say, you know what, I want $100 million. The bank says, well, it's actually 5% interest rate, okay? All of a sudden, the cost of borrowing $100 million is a lot cheaper. And that's the point we're trying to drive at here, okay? We say with money supply going up, we say that the interest rates come down, right? Why is that? Because when we expand the money supply, there's more money in the market, right? Interest rates come down. So it's cheaper to borrow money. So investments, companies like McDonald's will increase their investments. What does that do? Well, if investments go up, right, McDonald's is pumping in more money. They've pumped in $100 million into the economy. That gets multiplied, right? And we have the aggregate demand going up. And what does that do? It does all sorts of good things for us, right? So we've seen this shift, and I hope everyone's with me when they understand the money market graph. They understand the fact that when we shift the money supply to the right, the interest rates have gone down. Now let's understand this graph, okay? This graph is talking about our GDP and price level, okay? And they're talking about the short-run aggregate supply. When you see this short-run aggregate supply, we're in a recession. Normally we're in the horizontal area right about here, okay? Everyone understands zone 1 is the flat area, zone 2 is expanding, zone 3 is exponential, right? No one wants to be in zone 3 because that's high inflation. No one wants to be in zone 1 either because it's recessionary. Zone 2 is where the full employment rate exists. Okay, this is the LRAS. Okay, so coming back to our AD. Our AD originally is right about here. It's in a recession, okay? You come down, you see the equilibrium. That's at price level, let's call it PL1, okay? And it's at RGDPR, setting for RGDP in a recession, okay? We're at low RGDP. If you think about this is the RGDP at full employment, okay? This is what you need to be at, okay? So we're trying to shoot for this RGDPF, okay? We're trying to close a recessionary gap, a term that you learned 2 classes ago, I believe, or 3 classes ago, okay? The recessionary gap is the difference between RGDPF at full employment and RGDPR at recession, okay? So we're trying to close this gap, and what are we trying to do? We're trying to push the AD out. That's a way to increase it, right? Increase RGDP. So because our investment has gone up, aggregate demand goes up. If aggregate demand goes up, well, what we get to do is we get to put 2 arrows right about here, and we say 81 to 82, you better shift. So what it does, it shifts to the right, and what it does, it increases the RGDP. Awesome. And because it's in the horizontal part, there's not too much difference in your price level. So PL1 to PL2, well, it's a negligible change. Perfect. So output is up, more jobs, more in the economy, people are happier, and we've successfully used a monetary policy to expand the economy. Okay? A lot of stuff going on, but hopefully you'll make sense of it. Sort of reviewing the same thing, except in the opposite way, is contracting the economy. Okay? So let's go ahead and erase this, and we'll talk about a contractionary monetary policy. All right? Again, pretty much the opposite. So if you're expanding money, well, if you're having an expansionary monetary policy, what you're doing is that you are increasing the money supply. And guess what? For a contractionary, you do the exact opposite. You shrink the money supply. Again, how you do that? Primarily through OMO, open market operations, which is something we'll go over in this class. We'll do our best to go over that. So here is a contractionary monetary policy. Contractionary monetary policy. Okay, what happens in a contractionary monetary policy? Well, for starters, money supply goes down. Why is money supply going down? Well, the government says there's too much money. The way to control the economy is actually, well, first of all, before I get into any of that actually, let's start off with why we're trying to contract the economy. Normally, you're trying to contract the economy when you're having an inflationary period. So when you're trying to fight inflation, okay, when you're trying to fight inflation, right, you have a contractionary monetary policy because you're trying to contract the economy so price levels come down and people can afford stuff. So bread is not $40, but it's actually $4, okay, a lot more reasonable. All right, so money supply comes down. Okay, what happens when money supply comes down? Well, you guys remember from last time that interest rates actually go up, right? Because if there's less of something, things become more valuable, okay? How do we do that? Well, we can actually explain that using a graph, okay? A graph of the money market. Hopefully you guys got the hang of the graph of the money market by now. But let's talk about the money market, okay? Let's talk about the money market. Money market. Awesome. Okay, by now it should be pretty fast and easy for you. You've got money here on the x-axis, and what do you have on the y-axis? You have the nominal interest rate, okay? All right, so nominal interest rate on the y-axis, money on the x-axis. Okay, so what do you have? You have a downward sloping money demand, okay? Pretty simple, straightforward, like almost all demand. That D does not look like a D, there we go. Your money supply is vertical. Why is your money supply vertical? Well, we've established this before. We've said that the money supply is a constant number. Okay, it can be shifted, but it's actually constant. Okay, so it's not varying. So your MS is a vertical line. Okay, in this case, we're saying we're shrinking the money supply using techniques. Remember those 3 techniques that I taught you guys? 3 ways that the government uses monetary policy to enforce monetary policy. 1, they said that they can change the reserve ratio. We talked about the money multiplier, reserve ratio. 2 is that they can control the discount rate, right? Discount rate is the money, the rate at which banks are borrowing from the federal government. And 3 is they can do open market operations. And open market operations is primarily what moves the money supply. And that's something we'll segue into right after this. But okay, so the government uses open market operations, okay, whatever that thing is, we'll learn later. All right, so that basically what they do is they use that OMO and they say that, okay, cool, we've figured out a way to decrease the money supply. All right, money supply goes to the left. If money supply goes down, it goes to the left. Money supply goes up, moves to the right, okay? So here's MS, moves to the left, okay? We can obviously always name, we'll have this MS1 as the old one, MS2 as the new one, okay? And then what we do is we check the interest rate. So first let's check out the old equilibrium, okay? Going down here, you're at this M1, which is the money, the constant, and the old equilibrium. And then the old interest rate, which was at, let's call it I1. Now look at it. Look at the new equilibrium right about here, okay? You go over here, and obviously you end up with a higher interest rate. Why is that? Again, if you have less of something, it becomes more valuable, less money in the market, market becomes more expensive. The price of borrowing, which is this interest rate right here, goes up, okay? And then obviously the money has shrunk. It's pretty straightforward, okay? That was our goal anyways in the first place. Okay, so now we've established a relationship that if money supply goes down, we've said that, okay, the interest rates go up. Awesome. All right, what does that do to investments? Remember in the last time what we said was that if my interest rates go down, money is cheaper to borrow. What investments and what companies like McDonald's are going to do is they're going to say, hey, you know what? It's cheaper to borrow money. Let's go ahead and invest in our investments. Well, all of a sudden there's bad news bears, okay? It says that McDonald's goes to the bank and they say, hey, we need $100 million. Bank says, I'm sorry, it's not 5% anymore. It's actually 20%, okay? So all of a sudden, McDonald's and a lot of companies are discouraged and they don't want to invest anymore because it's expensive to invest and it doesn't make financial sense. They can't make profits off of investments. So what McDonald's does is they say no to investments, and so do a lot of companies, and that's why investments go down. And remember, guys, the golden rule, if C, consumption, I as in investment, G as in government spending or net exports go down or up, holding aggregate supply constant, what tends to happen is that the arrows follow. So if C goes up, AD goes up, I goes up, AD goes up, I goes down. In this case, AD goes down. Okay, so aggregate demand goes down. Why are we doing all of this? The goal is to fight inflation. The goal is to fight inflation. So the goal is to bring AD down. Remember, that is called deflation. Okay, that is called deflation. We're trying to deflate the economy when it's in an inflationary period. Kind of confusing, but you're trying to deflate the economy right now. Okay, so you fight inflation by deflating the economy. Okay, kind of confusing, but that's how it works. Okay, so we have the S Aureus graph, okay? S Aureus obviously has a horizontal, growing, and exponential, right? Short run aggregate supply, short for SRAS, okay? And normally in your zone 2 is where your LRAS is, and LRAS operates at a GDP at full employment. So this is where you want to be, okay? But actually we're doing at a better output, but unfortunately we are at ridiculously high levels of price level. PL standing for price level over here. So if you have an 80 graph, or 80 line right about here, let's call this 81, you have an output that's close, that's actually beyond the full employment GDP, not by much, but it's actually above it, so that's not bad, right? Actually, it's pretty good. But here is the biggest problem. It's the price level right about here, right? PL1, if you look at it, normally in the last graph, we were right about somewhere about here, okay? That was a recession. This is also not good because if you look at it, if you look at the way that if you work at full employment, right, which we think that is the natural rate of unemployment, okay? If you look at the price level over here, right, PL, let's call this PL2, okay? It's significantly lower, okay? And it makes a lot more sense, right? We can actually afford things. Our income actually makes sense. When the price levels are extremely high, our income levels don't make any sense, right? Because what good is it if you make $1,000 a month if you're paying $400 for bread, right? So the point is to bring 80 down. And we've done that with the contractionary monetary policy. We've said money supply coming down makes the interest rates go up, makes the investment come down, makes the aggregate demand go down. A lot of words there, but I hope you guys understand that, right? So aggregate demand comes down. Well, we're trying to deflate the economy, right? Because the investments have come down. McDonald's thinks it's way too expensive to invest, and so do a lot of companies. So investment has come down. Aggregate demand has come down. Shift left, always parallel shifts, right? And we go over here and we check this out and we say it's 82. The good news is, okay, the bad news, let's start with the bad news first. Our GDP has kind of shrunk. But by how much? A very, very tiny little amount. It's actually not that bad at all. It's sort of when you move at price level when you're in the flat zone, not by much at all, right? But here's the benefit. Price levels have come down dramatically, right? We've gone from PL1 to PL2. Fantastic. Our bread does not cost $400, it costs $40. Makes a lot more sense, right? You can afford things, you can buy other things, and you can consume other things. So good news overall, right? So that's how a contractionary monetary policy works. One more time, I'll walk through a little slowly, but we'll just go over it on the big picture view, okay? Contractionary monetary policy works to fight inflation, okay? They're trying to deflate the economy. How do they do this? They try to decrease the money supply. Decreasing money supply increases the interest rates because there's less money and money is more valuable. And interest rates is the price of money, okay? So money is more expensive, price of money has gone up, interest rates have gone up. Investments have come down. Why? Because it's harder to borrow money. It's more expensive to borrow money. So firms and people are discouraged, so investment goes down. If investment goes down, as I said, C, IG, and net exports all affect aggregate demand. So as usual, if I goes down, 80 goes down. Well, on this graph, it translates pretty well to us because we're trying to fight inflation. And normally when you're trying to fight inflation, you are in the third zone, okay? Third zone. In the third zone, you have a very high price level, okay? A nice GDP, but you have a problem with the price level. So you're trying to fight the price level. You want the price level to come down. And shifting the 80 to the left, because of the fact that investments have gone down, is the right remedy to this solution. To this problem, because the price level does come down when you shift the 80 to the left, okay? So this is a contractionary monetary policy. A lot of stuff going on, but I hope you guys understand it, okay? So we've went over two things. We went over expansionary monetary policy in the last class. This class we've gone over contractionary monetary policy. All right, so let's try to come to a conclusion with this monetary policy deal, okay? Let's talk about what we do in a recession. Let's talk about what we do in inflation. Both of which we've already talked about graphically, but using a simple flow chart and a simple logic, let's try to get a big picture view of monetary policy, okay? And then we'll try to dig into exactly how the first part, right, we've kind of skipped over that. We've said, well, money supply goes up, money supply goes down. We've kind of danced around the issue of how that happens. And I talked about a thing called open market operations, which we will talk about. But first, let's talk about in a very generic view, how we talk about monetary policy, how we fight inflation and recession. Two words that we love in economics, okay? So monetary policy. All right, so let's start off with our not so favorite, recession. A word that almost everybody now knows, right? Even people who are not learning economics. Okay, so in a recession, what do? Our goal is to increase the GDP, right? Our GDP must go up. So we, as monetary economists, we say money supply must go up, okay? Money supply must go up. So money supply goes up, we've graphically established this. Okay, there's more money in the market, money is less expensive, money is less valuable. So nominal interest rates actually come down. Okay, if nominal interest rates come down, we said that it's cheaper to borrow money, so companies like McDonald's can invest, and so investment goes up. If investment goes up, we said that C or I or G or net exports go up, automatically the aggregate demand goes up, which is our goal, because eventually what we're going to come to is the following. So if AD goes up because I goes up, okay, I'm going to come over here. Okay, if AD goes up, this is a flow chart from last time. Okay, AD again went up because investments went up, because it's cheaper to borrow money now because of the lower interest rates. We said that if AD goes up, we said that our GDP goes up. Okay, if our GDP goes up, we said that, well, the output is better, so there's more money in the economy. We need to do more work because companies want to make better profits. So they hire more people, or employment goes up, or unemployment goes down. Either way you want to look at it. The other way is inflation, how to fight an inflation. But hopefully, before I jump into inflation, you guys understand a recession. Okay? Overall money supply going up affects interest rates, affects investment, and affects aggregate demand. Aggregate demand affects our GDP. Our GDP affects employment and unemployment. Okay? So let's talk about inflation. And I'll take the arrows out because as they turn out, you guys probably already know this, they're the exact opposite. Okay, so inflation, what's happening in inflation? What's our going to inflation? Well, the prices are too high. Things are too expensive. Normal things like you buy bread, food, milk, whatever you want to buy, things are really expensive, right? So you want to fight that. As a government, you want to say, hey, you know what, my people want to have a better life, and we need to fight this price level going up. So what we do is we come up with a contractionary monetary policy. Right? Contractionary monetary policy. And that is meant to fight inflation. Okay, meant to fight inflation. How do we fight inflation? Well, we have the money supply going down. Okay, money supply going down. Now, if there's money supply going down, we say that there's less money in the economy. Money is now more valuable, right? And the cost of borrowing money actually goes up, and that comes in the form of nominal interest rates. So the price of money just went up because we decreased the money supply. Okay, what does that do to your investment? Now imagine we said we were McDonald's, we said that we go to the bank, okay? The bank says, excuse me, sir, it's not 5% anymore. What your interest rates actually are is actually 10%. So the calculation is off. McDonald's says it's too expensive, okay? And so do a lot of other companies, and investment actually comes down, okay? So if investment comes down, what happens to my aggregate demand? Let's think about it. I mean, we said that C, IG, and net exports all affect aggregate demand in the same direction, right? So simply speaking, if my investment comes down, aggregate demand comes down, okay? Which in this case is actually pretty good, but we have two hurdles to cross, our GDP and employment. Well, if my RGDP goes down, why? Because when my aggregate demand goes down, right, you're reducing the output as well, which is, in our case, measured by our GDP. So our GDP goes down. Well, you know what? Companies are not doing so great anymore because they've reduced output, so they don't need as many people. So unemployment goes up, employment comes down. The goal of all this, again, is that price levels go down. And this is how we fight inflation. With a contractionary monetary policy, we're successfully able to bring the price level down. And as long as you understand how to link money supply, okay guys, as long as you can link money supply and aggregate demand, okay, you're fine, okay? These are the two that you need to kind of link, all right? So that being said, let's talk about, the last thing we're going to talk about in this class, okay, is something called as open market operations, which I've been promising to talk about. Open market operations. Kind of sounds shady, actually. Open market operations. Okay, nothing shady about that. Actually kind of dry as a topic, but you know what? Bonds actually, since the recession, have become a safe commodity because, I mean, a very valuable commodity because they're very safe, okay? They're very safe. Before the recession, people made a lot of risky investments, okay? Now, after the recession, people understand that, well, we need to take care of our investments in a more risk-averse way. And so what people have done is they've invested more in bonds. And so people who are bond traders like PIMCO have become a lot more successful. Okay, so bonds made a lot of money to a lot of people post 2008. Okay, that being said, let's talk about this bond trading, literally, by the government, known as open market operations. Open market operations are basically when the Federal Reserve, and everyone hopefully knows who the Federal Reserve is. The Federal Reserve Board, guys, is elected by the federal government. They're a group of economists selected by, I believe, the President of the United States. I might be wrong, but the President basically, well, it depends. Actually, each state has its own. There's a Federal Reserve in New York, but basically there's the big Federal Reserve Board, and it has a Federal Reserve Chairman, and Bernanke is actually the current chairman. Before that was Alan Greenspan. But basically, the Federal Reserve Board gets to dictate what the what the federal fund rate is, 1, and 2, the discount rate, and 3, they get to decide how many bonds are being sold and bought by the government. And this is when the Federal Reserve, let me finish this definition. So open market operations are when the Federal Reserve engages in open market operations. Well, Federal Reserve Board engages in buying and selling of bonds, and more specifically speaking, Treasury bonds. To this day, guys, let me finish this real quick. Treasury bonds. Okay. So to this day, the most safe investment to make in this world is to buy a U.S. Treasury bond. Okay, to this day. Yes, they don't return as much interest rate. Okay, they probably give back about 3% or so, but they're extremely safe because they're backed by the U.S. government. Okay, so the U.S. government says that as long as we exist, we promise to pay you back. Okay, and to this day, they're the most safest investments to make. So that being said, the U.S. government, through the Federal Reserve, engages in this thing called open market operations and buys and sells Treasury bonds. Why does it do that? And by the way, who does it sell and buy to? Two people, mainly the banks, okay? And secondly, us, the public, because we can buy and sell Treasury bonds as well. All right, so that being said, let's talk about buying securities. We'll cover selling securities in the next lesson, but for now, let's talk about buying securities, okay? So why does the federal government buy bonds, okay? Securities are basically any financial vehicles. Okay, so not vehicles. So security is basically a financial package that you can buy, okay? So a security can include anything. It can include a mutual fund. It could include a bond, okay? In our case, we're talking about bonds. So let's talk about why the federal government buys Treasury T-bonds, standing for Treasury bonds. Okay? Why do they buy Treasury bonds? Well, what happens is in a recession, right? The government, federal government, needs to increase the money supply. Okay, remember, they need to increase the money supply. Okay, so they need to help expand how much money there is in the money market. Okay, so how they do that is by buying bonds. If they buy bonds from banks, they buy bond from banks. What they do is they give a huge chunk of money to banks, and in return, they get Treasury bonds. Okay, and what this does is that when they give the huge chunk of money to banks, and in turn they get bonds, that money goes into the money market, and that's how your money supply increases. So when you buy bonds, money supply goes up. Okay, we'll cover selling bonds in the next class, but for now, let me just give you your homework question. Okay, your homework question is draw me the flowcharts for recession and an inflation. So what happens when there's a recession? What happens when there's an inflationary period? How do you combat that using a monetary policy? So give me the flowchart. So money supply going up, what that does to the economy. Money supply going down, what that does to the economy. Thank you so much, and I'll see you guys in the next class.